Buffett's strategic cash reserve, a lesson in market anticipation. Warren Buffett's investment conglomerate, Berkshire Hathaway, has reached a new financial milestone, amassing a substantial cash reserve of $325 billion. This record sum, signaling a cautious approach in what many perceive as an overvalued market, underlines Buffett's renowned investment philosophy, which prioritizes thoughtful asset allocation over market timing. Interestingly, Berkshire Hathaway's significant cash holding comes at a time when Buffett's preferred market valuation metric, the market value to GDP ratio, sits at an all-time high, suggesting potential overvaluation and lower future returns. Historically, Buffett has adjusted Berkshire's cash position based on such valuation metrics, balancing between equities and cash to optimize long-term gains rather than quick speculative profits. Over the decades, Buffett has demonstrated an uncanny ability to regulate his company's asset allocations in response to fluctuating market conditions. For example, from a mere 1% cash allocation in the mid-1990s, Buffett increased this to 13% by 1998 amidst escalating stock valuations during the internet bubble. However, he reduced it to 3% in 1999, a year before the bubble burst, indicating a missed opportunity to avoid the steep downturn that followed. In the run-up to the 2008 financial crisis, after initially reducing cash allocations, Buffett sensed turmoil as stock prices began to falter in 2007, leading him to significantly increase Berkshire's cash reserves once more. This strategic move allowed him to make opportunistic investments during the crisis, such as his notable stake in Goldman Sachs. Buffett's investment strategy illustrates a fundamental principle: the inverse relationship between valuation and future returns. This principle suggests when assets are priced high, their future returns are likely to be lower, and vice versa, a rationale that has guided Berkshire to its current enormous cash reserve. Moreover, the current state of the market, with the S&P 500 trading at 25 times forward earnings, well above the historical average of 18 times since 1990, points towards potential contraction and subdued returns. This scenario aligns with the modest 4% annual return projected for the S&P 500 over the next decade, highlighting the relatively more attractive yield from safer assets like 3-month Treasury bills. In essence, Buffett's decision to hold a massive cash reserve is less about predicting the exact market drops and more about being prepared for an investment landscape where equities offer limited upside potential compared with less risky assets. This pragmatic approach can serve as a prudent lesson for investors navigating through today's volatile markets, emphasizing the need to focus on value and long-term returns rather than short-term speculative gains. Thank you for choosing Satori News.